Welcome to Forex.com's webinar series. Before we begin, let's go over a couple of disclosures.
Hi, I'd like to welcome everyone to our Introduction to Candlesticks class. My name is Kelly Durazo. I'll be your instructor for today's class. For the next few minutes, we're going to be covering a lot of different areas of learning to interpret candlesticks on your Forex charts. And some of those topics that we're going to be covering in today's class is first the importance of charting and then the different methods that you could use to view your charts. There are three common types of charts that traders use. We're going to go through each one of those. I'm also going to give you an introduction to candlesticks, really show you what a candlestick is made up of. And we'll also give you an overview of some of the most common candlesticks that are interpreted in this market. We have quite a few to go through. And then we're going to use candlesticks to identify trading opportunities because ultimately that's what we want to be able to do. We want to use these to enhance our strategies to give us more possible trading setups in the market. Now, when analyzing this market, there are two types of methods that you can use. Now, we can use fundamental analysis, be more of a fundamental trader, or we can use technical analysis, being more of a technical trader, or you can use a combination of both of those. Let's go ahead and start with fundamental analysis and talk about what fundamentalists do. Now, fundamentalists, what they do is they study the cause of market movement. So this includes things like supply and demand, a lot of different economic data reports. These are coming out 24 hours a day throughout the week. And we're going to use this information to make their trade decisions and anticipate which way the market may move. Now, the other way that we can analyze the market is using technical analysis. So a technician, on the other hand, is going to study the effect that the fundamentals cause. They may even try to follow the trend, but they're definitely interpreting technical trading setups on their charts. So again, when you're talking about fundamental analysis and technical analysis, you want to think of it as cause and effect. Fundamentals being the cause of that market movement, the technicals that we see on our charts, that's the effect that those fundamentals are causing. Now, when technically analyzing the market, there are different types of charts that you can use as well. And when you're looking at those charts, these are just different ways of physically representing market data. Now, there are three different types of charts that you can choose from. We have the line chart, the bar chart, and then the candlestick chart. So let's go ahead and start with our line chart. Now, on a line chart, the openings, highs, and lows, these are all ignored. So what you're seeing is the closing price being plotted. Now, a continuous line is going to join those closing prices, and the line chart doesn't give us as much visual information as other charts, but in some respects it can be more helpful. So for example, since the highs, the lows, the openings are all ignored, a lot of that market noise, those short-term pricing fluctuations are eliminated, and this makes it a little bit easier to spot trends and then reversals. And it is very easy, very simple to toggle back and forth from one chart to the other. So let's say that you usually use a candlestick chart to do all of your analysis. Sometimes if you're having a hard time maybe identifying something on your chart, maybe it's a chart pattern, a specific strategy that you're looking at, what you can do is you can just simply toggle back, change your chart very easily to a line chart. And again, that's just going to smooth out those prices a little bit, just joining those closing prices that we talked about. Sometimes by doing that, it can make it a little bit easier to spot trends or those reversals or different strategies. And then once you have your verification, then you can simply toggle back to the regular chart that you use. That's just one way that you can use that line chart to your benefit. Now, the second type of chart that you can use is our bar chart. Now, this method shows pricing action using vertical bars. So the bar represents the trading range for the stated time period. The top of the bar records the highest price that the market traded during that time period, and then the bottom of the bar records the lowest price. And then the tick mark on the left records the opening price, while the tick mark on the right records the closing price. Now, the third and final chart that most Forex traders use, this is really the number one chart out of the three charts, probably looks the most familiar to you. This is our candlestick chart. Now, a candlestick chart, sometimes just referred to as a candle, consists of a vertical rectangle. This is what's called the body of the candle. The vertical line on top of the candle is the wick. The vertical line below the candle is what's known as the tail. And these vertical lines on top and bottom are also referred to as an upper shadow or lower shadow. But basically, each candlestick displays the high, the low, the open, and closing price points over a specific period of time. Like I said, this is the type of charts that most Forex traders will use, coming in really number one. Number two would be that bar chart, and then number three is the line chart. Now, a couple things I want to say about this chart in front of you, the candlestick chart, because we do usually get this question. First of all, you've heard me mention a couple times the stated time period. Now, you can view your chart anywhere from a minute time frame up to a monthly time frame. You're going to be able to change the time frames on your chart. I always get the question, what time frame should I use when I'm looking at my charts? And that's going to depend on what type of trading that you're doing. There are three common types of traders. We have day trading, swing trading, and then position trading. Day trading being the most popular, not referring to trading every day, but really referring to the amount of time that we're in that trade. So a day trader is going to hold open their position anywhere from a minute, a few minutes, up to a few hours. They're closing all of their positions by the end of the trading session or the end of the trading day. They're not carrying open any trades overnight. A day trader is going to be trading off of very small time frames, anywhere from 10, 15 minutes up to 60 minutes. They're really looking for just small gains in the market, small profits that they can take. And then we have what we call swing trading. Swing traders are going to be trading off of a little bit bigger time frames, 60-minute, 120-minute, 240-minute, and they may hold open that trade for a couple days. They're looking for a little bit bigger profit than the day trader, and it may take a couple days for their take profit price to finally be realized. And then we have really what we're doing is looking at the big picture, going to some position trading. Position trading is a trader who's going to hold open that trade weeks, maybe even months, really looking at the big picture, trading off of daily, weekly, and monthly charts, very large time frames. And they're looking for a much bigger return on that trade. So they're really in it for the long haul. So depending on what type of trading that you're doing, that's really going to depend on which time frame that you're looking at on your charts. Now, also, you're looking at our chart in front of you, which is a typical chart that we have on our Forex Trader Pro trading platform. We offer that absolutely free. You can go to our website to download that and use that for free, www.forex.com. And the chart in front of you that you're looking at, again, this is a chart on our trading platform. It does have a live data feed, so you are seeing real-time market action as the market's open, as it's being traded. And you're going to notice that our chart may look a little bit different than yours in respects to our candlesticks being colored. Now, that's something that we did specifically, and I'll tell you the advantages to that, and you can go and change the colors of your candlesticks as well if you want. And what we've done is we've changed our up candlesticks to green, our down candlesticks to red. Now, this is going to make it very easy on your eyes, especially if you are watching charts for longer extended periods of time. So if you look at your charts very quickly and you saw a lot of red candlesticks, we would know instantly that the market was dropping. There may be a rally going on, but we know the prices are going down. The opposite, if we looked at it and we saw the prices going up, we saw a lot of green candlesticks, we would know very quickly that those prices were rising. And again, you can do that on your charts. Usually just right-clicking on the candlestick will open up a property box and will allow you to change the colors of your candlesticks if you wanted to do that. Now, why candlesticks work? Now, candlesticks very clearly show the struggle between the buyers and sellers because that's what's in effect what we're seeing on our charts. When you're looking at those charts for the first time, or maybe you're very new to this market, it can look a little overwhelming trying to figure out what's happening in those charts. But the more education that you take in, the more classes that you take, and the more that you're watching your charts and learning different strategies, the more that those charts, that technical analysis, is going to make sense to you. Now, they can also give us a clue as to whether the market may reverse or continue in the direction that the market is moving in. So let's just quickly go through a candlestick individually. We've talked about what a candlestick is made up of. We really want to focus in on one candlestick so we can see what we're seeing. Now, this candlestick in front of you, let me get my pointer on so you can see exactly where I'm at. Here, this is showing, this candlestick is the body of the candle. So we have that colored part being the body. We have the wick here, this line above it, and this is the highest area that the market traded at, the highest price point. The wick on the bottom, or the tail, you can call it either. This is the lowest price area that the market traded at within the time frame, whatever time frame you have your chart set to. This is going to be the opening price, the price that the market opened at. This is going to be that closing price. Now, the rule of two, and this is something I'll mention now and something that we'll go through as we're going through our class today. But as I mentioned before, we can use candlesticks to predict possible market movement, but we do want to stick to a couple of rules when using the candlestick method, and that's that no one candlestick should be judged in isolation. So just like if you were reading a book, now we don't pick up a book right in the middle and just pick out one or two words. If we did, we really wouldn't understand what was going on in the story. If we look at the surrounding context now we can get a little bit better idea of what's happening. So think of it that way when you are looking at those different candlesticks, not looking at just one, but really looking at the surrounding area of those candlesticks. And I'll show you what I mean by that as we're going through our class today. Now let's go ahead and talk about some of the most popular candlesticks, the ones that we see the most common. So we're going to go over some different candlestick patterns that can tell us that the market may be about to reverse direction. So I'm going to show you four of the most common patterns that we see on our chart. So we have the doji, the hangman, the hammer, and the engulfing pattern. Now there's a lot more candlesticks out there, candlestick formations. I do recommend everyone to get some kind of candlestick book for their trading library. This will make it a little bit easier as you study through that. Of course, I'm going to give you some of the most common ones that we do see in the market all the time. And what we're going to start with is our doji candlestick. Now, this is probably the most common one that we see. It's also the easiest to interpret as well. So the doji candlestick, as you can see, it's missing something very specific compared to the other candlesticks around it. And that's really what makes it so easy to identify, the fact that it's missing the body, the colored part of that candlestick. So as you can see, it has no colored body. And this is showing that the market closed at the same price that it opened at. So it's showing some indecision in the market between the buyers and sellers, almost a struggle, and it can often be an early warning that a preceding rally could be losing steam. Now the doji candlestick, a couple things you want to remember. If it's present in an overbought or oversold market, it can be very significant. Now when I say overbought and oversold, let me really give you an explanation of what I'm talking about. Now the market is always moving in one of three directions. Either we have uptrends, downtrends, or the market's just moving sideways, what we call a ranging market. Now the market, when it's moving in a trending movement, that trend will eventually become overbought or oversold. Those trends won't continue on indefinitely. So let's say that we've been watching an uptrend for a while. Eventually it's going to top out and we're going to see some kind of retracement, or we may even see a overall direction of the trend. So that trend will become overbought. if you see a doji candlestick forming when a trend's been going on for a while, that's going to be more significant to us as that trend is becoming overbought. It's really showing us that the market may be about to change directions and move the other way. And then we have the opposite, a downtrend. Eventually that downtrend would become what we call oversold. And if we see some dojis forming, let's say it's bottoming out, some dojis forming, that's a signal to us that there's some indecision going on in the market and that it may be about to change directions. And then, of course, remember to watch the subsequent candles to see if the reversal is confirmed, something that we will be going through as we're going through our class today. Now, the doji candlestick, I'm going to show you some of the most common types of, and there are 4 of the doji candlesticks here. We went through our common doji. Now we're going to look at what we call the long-legged doji. So this is similar to the common doji, except it has longer wicks, tails, and shadows. So this is showing that there was greater price range of movement during that time period. So here we have that doji candlestick, and as you can see, looks just like the common doji candlestick, except it does have much longer wicks and tails on it, showing the same thing. All of these that you're looking at today, all of these candlesticks are signifying that there is a possible reversal about to happen. So that's the easy part. All of these showing a possible reversal. Your job is just to remember what that candlestick is and to be able to identify it. Just takes a little bit of practice, but again, they're all reversal candlesticks. And then we have the gravestone doji. So this is a doji candle that opens and closes at or near its low. So the candle ends up having a long upper shadow, no body whatsoever. It's usually seen at the end of an uptrend, a little bit rarer to see in a downtrend, though we do see them in downtrends as well. However, either are an indication of a possible reversal of the prior trend. And then we just have the opposite. We have the dragonfly doji. So this forms with the open and close near or at the high of the candles. So the candle has a bullish implication usually. Its long lower shadow shows that the market fell very sharply during the session, but that buying pressure pushed the price back up to close at or very near that session's high. But again, as you can see, very easy to identify because there's no colored body to it at all. Now, a couple of things about the doji candlesticks. We do want to take notice of where the doji occurs. If it's in the early stages of a trend, then it may not be as significant as if it appears after a substantial move. So in going back to those trends, remember we talked about those uptrends and those downtrends. So if a trend has been going on for a while, remember it'll become overbought or oversold, and then if we see the doji forming, that's showing there's indecision, there may be a reversal. However, remember those trends have to get started somewhere. And a lot of times a trend will, before it begins, the market will just be moving sideways, what we call a ranging market or consolidation or a channel. That means that there are an equal amount of buyers and sellers in the market just pushing those prices sideways for an extended period of time. So at that point, really it's equal between the buyers and sellers. No one has won out yet. Now, if the market's moving sideways, eventually it's going to be broken through. When it's moving sideways, we identify support, we identify resistance, and the market will break through either that support or that resistance, which is a significant low price area, support being kind of like a floor area, resistance being the opposite, a significant high price area in the market, kind of like a ceiling type area. And as you're identifying the support and resistance, like I said, one side is going to break through. If it breaks through the resistance, then a possible uptrend may be starting. If it breaks through the support, a possible downtrend may be starting. So in the very beginning, we will oftentimes see that sideways movement before the trend has started. And if you see some doji candlesticks forming within that sideways movement or before that trend has even started, it's not going to be as significant. That's really just telling us that there is that struggle going on between the buyers and sellers. It's very common to see those. They don't necessarily mean that there's a big reversal about to happen because we haven't even started our trend yet. And again, more significant if a trend has been established and it's been going on for a while, and then you start seeing some of those doji candlesticks. So keep that in mind when you're looking at those dojis and where they are in a trend compared to maybe the market just moving sideways and ranging. Now we're going to look at a chart, and this is an hour chart, so great for some day trading. Of course, you can use the candlestick method formations with any time frame that you like to use, whether you're doing some day trading, some swing trading, or position trading. And I'll go through those three types of trading techniques at the end of our class again. On this chart, again, as you can see, it's an hour chart, so each candlestick represents the high, the low, the open and closing price points within 1 hour of trading here, or 1 hour of movement. And we can see that those low prices are getting higher. Those high prices are also getting higher. And at this point, about 3 days into this upward movement, we can see that the market has topped out, creating some resistance, that ceiling type area. Now, if you're not very familiar with what support and resistance is, I encourage you to check out another webinar that we do have on our website called Introduction to Support and Resistance. This is a webinar where we really go over what support and resistance is, how to identify it, and we also show you a great trading strategy that you can start using in the market right away using that support and resistance. Many strategies are made up of support and resistance type strategies. Those are two words you will constantly hear in this market, support and resistance. So it is a very good idea to get a very good foundation of what support and resistance is and really understand how it works. And again, we do have that webinar free on our website if you'd like to check that out and extend your education. So again, here we have that resistance, and within that resistance, notice what we have. We have some nice doji candlesticks forming. So we've had about 3 days worth of upward movement. Now we have a couple candlesticks, those doji candlesticks. So again, that's showing some indecision in the market between the buyers and sellers, and it's showing that there's a possible reversal about to happen. Now we can see that the reversal has happened here. We can see that the market has dropped. We can see that we have two very red candlesticks in this case, and these candlesticks look very different compared to the other candlesticks. They have a lot of body to them. So if you see some candlesticks like these with a lot of body, especially when you see that correction, you see that retracement, that just means that there was a lot of movement, a very large push in the market as the market dropped at this point. A lot of volume when it did finally retrace. So let's go ahead and go to a couple other candlesticks. We have our hammer and our hangman. Now, because of their identical shape, you're going to identify these depending on where they appear in an uptrend or a downtrend. So they're going to have very long wicks, at least 2 or 3 times the height of the real body. They have very small real bodies with no upper wicks. Let's go ahead and start with our hammer. Now the hammer is going to appear at or near the bottom of a decline. That's why we have that name, hammer. That will help you really remember this candlestick formation a little bit easier. This is suggesting that the market is hammering out a base. So these are going to be seen in a downtrend. Of course, they all mean the same thing, that there's a possible reversal. And then we have the hangman. So the hangman has the same shape as the hammer, except that it comes after an uptrend, preferably at a new high for the move. So remember, it looks just like that hammer, except these are seen in an uptrend. And we can see here the market topped out at that point. We have that hangman, and that confirmed that there was a possible reversal about to happen. And then we had that reversal here at this point. Now, bullish and bearish engulfing pattern. Now, up to this point, we've been looking at single candlesticks. Of course, we always look at the surrounding area for support and resistance. Now what we're going to do is we are changing things up a little bit with this candlestick formation, because now we're looking at more than one candlestick. So this is going to consist of 2 consecutive candles. engulfing candle must completely consume the body of the previous candle. And the bigger the engulfing candle is, the more significant it's likely to be. So we'll start with the bullish engulfing pattern. So here we can see that the market falls, a dark candlestick forms, and then that second candlestick forms. We can see that right here. And the body, the colored part of the candle, is completely consuming that previous session's body. It's totally wrapping around it. This is showing that buying pressure has overpowered selling pressure. So this type of pattern basically involves trying to pick the bottom of a trend. And then, of course, we have the opposite. We have the bearish engulfing pattern. So the same thing, we can see all of this upward movement. It's really topped out, creating some resistance. And we can see that it forms this candlestick, and then the one next to it, the body, has completely overlapped or consumed that previous session's body. And then we can see with this next candlestick, we can see that the price started moving the other direction. Now I want to show you what this looks like specifically on a chart. Again, we're just looking at an hour time frame. Those lows are getting higher. Those high prices are also getting higher, very indicative of an uptrend, maybe a short-term uptrend. And we can see at this point right here, we can see that the market has topped out, creating some resistance. Not only has it topped out, but it has created a bearish engulfing pattern. You see how this candlestick here, the body of it has completely consumed the previous session's body. We can see that right here. And then we can see that the prices have just really dropped at that point, or they are dropping, really confirming that reversal candlestick. Now another candlestick I want to show you, this is a bonus candlestick just because we see it very clearly on our chart, and it looks very different from the other candlesticks, and it's a very easy candlestick to identify. Now this candlestick here, as you can see, looks very different from the others. It has very long wicks and tails with just a small, almost pinprick of a body. This is called a spinning top. It actually looks like one of those spinning tops. That's what really helps us, helps in making it very easy to identify this candlestick. And this is a reversal candlestick as well. So we see we have this upward movement. Now the market has turned around. The market is going downward at this point. Now the spinning top forms, and that shows that that downward movement was potentially about to turn around, and we can see that right here. So if, for example, this is an hour chart, great for some day trading. If you were day trading this would have been a great opportunity here. We can see that it hit this high price area about at this level, and then the market just kept really trading sideways. But we can really see how that spinning top helped us to identify that the market was possibly about to turn the other direction. Now, to conclude our webinar, what we always like to mention is that although using candlesticks can help you identify new trading opportunities, it is important to realize that they will not always produce winning trades. Now, that's really with any trading strategy out there. Now, there are a lot of trading strategies out there that you can use, a lot of great strategies. However, due to the unpredictability that we see in this market, sometimes not all trading strategies are going to be 100% predictable, 100% effective, 100% of the time. That's really, again, with any trading strategy out there. And that's this market can be unpredictable. It's based on that cause and effect. Remember those fundamentals, really the economics, the change of a political leader, a natural disaster. All of those can produce some unpredictability in this market. And so maybe you're using a trading strategy that you've used a lot of times before and it usually works out for you. And then maybe there's that time that it didn't. That's just due, again, to the unpredictability that we do see in this market. Now, to wrap up our class, what we always like to do is we like to end with a question-answer session. So if you do have any questions, you can simply type those into the chat window there at the bottom of your screen. We did have a question here in relation to the 3 types of traders. I'll go over those again. When you're looking at your charts and you're trying to decide what time frame that you want to, you're analyzing, it really depends on what type of trading that you're doing. So usually there are day traders swing traders and position traders. Day traders, not actually trading every day. You can trade every day, but it's really referring to the amount of time that you're in that trade, anywhere from a few minutes maybe to a few hours, closing that trade by the end of the day or trading session. And that type of trading involves looking at very small time frames again, taking short profits. So we have the, anywhere looking at from a few minutes to up to 60 minutes. And then we have swing trading, who's looking for a little bit bigger profit than the day trader, holding that trade open for a couple days at a time, looking at 60-minute, 120-minute, 240-minute. And then we also have our position trading. So really looking at the big picture, trading off of large time frames, daily, weekly, monthly, and those trades you're going to hold open for, weeks or months at a time. And just to let you know, if you can split up your lots, if you can trade more than one lot, you don't have to stick to one type of trading. What you could do is maybe trade a lot on one currency pair using a position strategy where maybe it gets into the profit and then you just have to manage it by pulling up your stop loss. And then you could, at the same time, be trading other currency pairs using some day trading. So you don't have to stick to just one and kind of put yourself in a small box. You can use those different methods. We do have other classes. If this was a little bit advanced or you're very new to those candlesticks, we do have some other webinars on our website. Getting started in Forex, that's a great one if you're really kind of in that introductory phase, you're in that beginner stages. That's going to give you some great terminology. It's going to give you some basics of the Forex market, how it's traded, how it works, how you can become a part of that. And we do go through a trading strategy. And then another one that we have is our Introduction to Support and Resistance. That's a great one as well. That'll really show you how to view those charts, what you're seeing on those charts, especially in relation to support and resistance, which makes up a lot of trading strategies out there. You really have to have a good foundation of support and resistance to understand what you're technically seeing on those charts. So that's another great one. And those are all free. You can check out our website. If you click on the tab Learn, if you go to www.forex.com, click on the tab Learn, and that'll take you to a lot of free education that we do offer. We also offer some classes that you can take, online classes, where you'll have access 24 hours a day to an online curriculum to really understand how this market is traded and how you can trade that. So with that being said, we will go ahead and wrap up here. I want to thank everyone for joining us, for taking the time out of your day to join us on our class. It's been a pleasure, and everyone continue to learn and continue to trade this market. So everyone, have a great day. We'll see you next time.